Hi there, how are you? Mortgage Genie back to help you to become an informed homeowner or investor. Today, let's talk about those zero down loans, those 100% loans. Are they really 100%? Are you really, truly not paying any down payment? Well, let's dive in. There are some 100% loans. You have your Fannie Mae, your Freddie Macs. Fannie Mae, Freddie Macs, they give you up to 70. One of them give you the $5,000. That's a true credit, if that's how much your down payment is. The 7,500, that's a true credit. Now we do have 15 up to $15,000. And if you think about it, that's like a $400,000 house. That is a true credit, but you have to pay it back. You have to pay it back whenever you refinance or whenever you sell your house. Now, what is truly true down payment is the ones that comes from your county and your state and your cities. Those are true down payments also, but some of them are repayable. Now, the one in Pennsylvania, that's repayable. You do have to make a payment. And the good thing about that is the thinking is you're not coming up with the money all at once. Even though it's repayable, and that's what they call it. It means that you're making a payment for a certain term. And when I say term, I mean a number of years. But it's a good thing because you don't have to come up with that money all at once. But what they're doing in Pennsylvania is extraordinary. And I'm going to tell you why. They get rid of PMI. They give you up to $50,000 so that you can put down 20% so that you don't have mortgage insurance to pay. Now, I'm not talking about homeowners insurance. Everyone has to get homeowners insurance when you still owe. But even if you don't owe a mortgage, you're probably not required, but you want to have some insurance because that's a big investment that you have there and you want to protect it. But that's not what I'm talking about. I'm talking about mortgage insurance, PMI. Okay. Maryland do have a $25,000 one, and that's forgivable over a 10-year period. And they do have another $10,000 one. So Maryland have quite a few because there's one that's 10,000. There's one, and then you get an extra 5,000 if you have if you're disabled, and then they have this other 10,000 if you get what they call V to V, if you get one of those vacant properties that they've been trying to rehab. So there is money out here. Now DC give you up to $204,000. But but there's always a but, right? That money you have to pay back. You have to, whether you refi your house or when you go to sell your house, you have to pay that money back. And it don't go anywhere. I did a refi for this lady who house is being, she bought her house in the 70s, guys. She bought her house in the 70s. And it's been paid off for eons. And she says, I would like to do a HELOC. A HELOC is a home equity line of credit. And I said, sure. So I go to do a HELOC for her. And I said, there's a $30,000 lien on your property. And she says, no, my house has been paid off since, for the last 10 years. I said, well, there's a lien for 30,000. And then I thought about it and I said, did you use HPAP to purchase your house back in the 70s? And she says, yeah. Back in the 70s, DC had this same program. It's called HPAP, and it was 30,000 back then, and it never goes away. So when we went to refi her house, we paid that $30,000 lien off of her property. There are some in Virginia. I don't have the name of them, but there are some in Virginia, South Carolina. There are some. I don't have the name, but there are down payment assistance in South Carolina too. Now, Florida has one that's in Hillsborough County that's 30,000, and I think theirs go up to 70,000, and you do have to have a qualifying score. Rest of them you don't have to have a qualifying score. The one that's for Fannie Mae and Freddie Mac, you do have to have a qualifying score for those. So those are true down payment assistance programs. They are actually some of them, like I say, some of them must be paid back, but only when there's an event for your properties, such as a refinance or a or you sell your house. So yeah. Now let's talk about the ones that the lenders have. Okay. Now, I'm not saying that it's not a good thing. You make the call. When lenders tell you they have 100% loans, I have them. I have plenty of them. 100% loans. And remember, there are requirements. There are minimum requirements. For example, FHA requires that you put 3.5% down. Conventional loans require that you put 3% down. VA, there's no down payment, and USDA, there's no down payment. Now, I do have other off market products like I can use your bank statements, and you would have to put like 10% down for a bank statement loan. I have stated loans, but that's all different. But those don't come with down payment, okay? Unless you use one of the local municipality loans, then you can use the down payment program with that. Let's say you are a business owner. What do? Business owners always try to write off everything on their taxes. And then their Schedule C's, they try to have a loss so they don't have to pay but so much taxes because, we pay taxes every quarter. So at the end of the year, you like, I don't want to pay any more. So you try to zero out and make it so that you don't owe anything else. When you do that, then you don't have any income to purchase a house, because if you are a business, then when you come to purchase a house, we're going to ask for your Schedule C's or your K1s, and we're going to look at the income that you claim there. Some things we can add back in and give you some income, but that's really, really, really getting complicated and into the weeds, and you probably don't want to hear that. But if say you're in Pennsylvania, right? And you are a business owner and you was like, no, I pay every quarter. When I get my taxes, man, I'm not trying to pay anymore, and you have a loss. I can say, well, why don't you give me 12 bank statements and I'll count all the income you had coming in for that whole 12 months on your bank statements. Add them all up, divide them by 12. There's your monthly income. Simple math, right? Then you go and use one of these loans to cover your down payment, because you're going to need to put down at least 10% with those type of loans. 10%, sometimes they ask for up to 20%. So if you're in Pennsylvania and you are a business owner, that is a great product for you, and it's also for DC. Now, in DC, remember, you have to make sure you get qualified because that money goes quick. That money goes quick. So if you're in Washington, D.C., and you are a business owner and you want to use a bank statement for your a bank statement program, so those type of loans these type of down payment assistance will be great for those type of loans. But again, just ask me about them and I'll let you know. Now again, remember the requirements: 3.5% for FHA and 3% for conventional. So let's do an example. If we have a $400,000 loan, FHA is looking for your input to be $14,000. Conventional is looking for your input to be 12, right? So let's do the real math here, okay? So with the real math, if you're getting down payment assistance from the lender, right? They're going to charge, those rates are going to be a little higher because what are you doing? Your down payment is not coming in at one time. You're spreading it out over a period of time. And it's usually about 10 years, you know. So if in FHA, say you get a rate, and the rate is going to be higher because today the rates are like 6.5. But for a down payment assistance program, it's going to be about 7.5, right? So that means that they're going to charge you over a 10-year period 2 points higher to use that money over and spread it out over 10 years. And that's going to add on to your payment, a monthly payment of $183.08. But it's only for 10 years, right? But get this. Say if FHA, we say that you needed $14,000, right? They're going to make a payment of $183.08 over a 10-year period. But let's say you actually you go to closing. Points and fees are tax deductible. You just may get a refund. If you get a refund, pay that sucker off. Yeah? Or pay half of it off. And then the following year, you have, because you're a homeowner, you have other tax shelters. You have homeowners taxes. Now you have other things that you can claim on your taxes to reduce your taxable liability, which could result in a refund. Means that you made an overpayment. And then pay it off. Then your payments, your monthly payments is going to drop by $183.08. Good deal, right? But a lot of times, if you're getting these down payment assistance, doing the real math, and ask the questions, doing the real math, they usually charge you an additional point, which in this case, for $400,000 would be $4,000. So the actual credit that you're getting is $10,000. We can count all day long. Real math is real math. You may get a credit of $14,000, but your closing costs going to have an additional $4,000 to it. And real math means that you're bringing $4,000 to the table. And but you owe them 14. So you're really getting 10. But the good thing about it is, the pro is that you're not coming up with that one lump sum of $14,000 at one time, and you can actually spread it over a 10-year period, or do like I tell my clients to do: pay that off in 2 years. And it may not be a 2 year situation because, like I said, points and fees are tax deductible, and it could result in you receiving a tax refund. And don't throw away that tax refund or go and buy something frivolous. Pay that down payment assistance off that you have and reduce your payments by almost $200. So when you see that they have 100% loans, you should ask some questions. One, is there a monthly payment? If so, what are the rates and for how long do they want me to pay it? It's the same thing as saying, what are the terms? So you want to ask, is there a monthly payment and what are the rates and terms? That's what that first bullet means. Okay? And then you want to know, are any points being charged for this down payment assistance? Because I have seen 0 points being charged, and I have seen points being charged almost up to 2 points. So ask and ask. And here's the big thing, right? I told you, FHA requires you to put 3.5% down. Conventional requires you to put 3% down. Ask them, can I get more? Yeah. Can I have more? Do you have a down payment assistance instead of 3.5% down? Can I get 5% down? Or don't put the percentage on there. Ask them, is there a higher down payment? Do you offer a higher down payment? We do. We offer, even though FHA requires 3.5%, but I do have a 4% and I have a 5% down payment assistance program. But again, you will make that payment over a 10-year period to pay it off. And if you pay it off early, there's no prepaid penalties or anything like that. But ask questions. Yeah, ask questions and see if this is really a down payment assistance. Is this really 100%? Is it really 100%? Right? So, don't forget to, please, guys, take the time out right here. Please take the time out to subscribe. It's free, and I can continue to bring you content that matters, because I know that you see those 100%. If you're in this space and you're looking for a home, you see those 100% loans. And let me tell you another little tidbit. In the Detroit and the Baltimore, Maryland area, they're offering those homes for $1. Those are not investors. They are not for investors. I have gotten so many calls where the investors was like, hey, I want to pick up those dollar homes in Baltimore. Those are for people who are becoming homeowners. Baltimore City is not going to let you, as an investor, take a house for $1 and then sell it for $300,000 and make that. They're not doing that. They're not doing that. You can buy a block of homes in Baltimore, but you have to go into my investment information to find out about that. But subscribe. Bye.